And so when you add that 12% return and you add and take the purchase price and the tax savings and all that, most of our clients, almost all of our clients in the middle market, end up with more money in their pocket at the end of the day than if they had sold to a competitor or private equity. Or now, there's exceptions, obviously, but most of them end up with more money and they accomplish all the other stuff they're looking to get done.
From Ray & Associates Studio, this is Unsuitable, a management financial services podcast for entrepreneurs, tenured business leaders, and others who are ready to look beyond the suit and tie culture for meaningful, measurable results. I'm Doug Hauser. At some point, if you're a business owner, you'll have to think about trading your business in for retirement. And when it comes to identifying an exit strategy, you have a few options to choose from. You can liquidate, keep it in the family, sell it to the highest bidder, or you can get your employees involved. Employee stock ownership plans, also known as ESOPs, have gained a lot of traction in recent years. Ted Lape, a senior partner with Lazear Capital Partners, is here to explain what an ESOP is, what it isn't, the benefits of starting your own, pitfalls, best practices, and more. Welcome, Ted.
Hi, Doug. Great to be here.
Thanks for taking the time. So ESOPs, talk to me a little bit about that. If I'm a business owner, I hear a lot about that, but I don't really know what that means other than my employees are going to be involved somehow. So
basically an employee stock ownership plan is a defined contribution plan, a lot like a 401k, only instead of having Apple or IBM in the plan, you've got stock of the company that you work for.
Okay. So obviously, if I'm an employee, then I have a vested interest in seeing the company be successful beyond my own pay and that sort of thing.
Yeah, that's the whole idea. And there's a lot of third-party peer-reviewed studies that show that companies that sell to ESOPs get that benefit, that the employees do, in fact, start to care more and that they get better productivity,
Awesome.
Less turnover, better recruitment. If they embrace it and communicate it and do all the things you got to do to let people know it exists.
Now, talk to me about when this might be appropriate for a business owner. Is there a specific company size that fits well, or a certain revenue or EBITDA level where they seem to fit?
That's a great question. We tend to think of it in terms of earnings, because you want to have a certain value to do this, because there's some legal stuff you got to do and some complexity. It's manageable. But if you've got $1.5 million or two of what we call EBITDA or cash flow, think of it maybe as net income adjusted for excess owner salary or whatever. Then you're probably big enough to be thinking about it.
Okay.
But you also want to have some other things. The number one thing you want to have for an ESOP is good management.
Sure.
So if you're an owner who's thinking, gee, I'm done and I want to go to Florida, well, I think that's great. You ought to go to Florida.
Right.
But you probably should just sell your company to a competitor.
Mm.
However, if most of our clients, the owners, want to stick around for a while, they may not yet know who's going to take over after them.
Okay.
They commit to figuring that out.
Okay.
Or they've got pretty good management already, either one. And so that's for the first prerequisite.
So maybe I want, 3 to 5 years of kind of tapering down what I do and get the next level of management sort of trained up, that kind of thing.
That would be very normal. And sometimes they think, I can train up the next level of management. And sometimes they think, gee, I'm going to have to bring someone in.
Okay.
And we see both all the time.
Interesting. So now from the perspective of the owner, the benefit is I still get something to do, right? I stay in the business, I stay involved, my legacy stays around, that type of thing.
Yeah, so there's two, I guess, sets of benefits. When I first started dealing with ESOPs, I focused on the first set of benefits, which I'll call the features and benefits of ESOPs.
Okay.
And then the second set, really in the last couple of years, we've really come to understand that that's almost even more important. As good as the first set are, that the second set maybe even more important. The first set is, just to give the shorthand, there's the ability to keep running the company. Some people think the employees start running it. That's not really what happens. The second set of benefits is there's a ton of tax advantages. The owner can potentially sell tax-free.
Okay.
The company typically will become tax-free. And there's some additional tax savings that would take longer to explain.
Right.
And then there's a lot of times the owner feels a real benefit out of the fact that the employees, and especially the key employees, we hear a lot of focus on, I've made a lot of promises to the key employees. They really helped me build this thing. They're going to help it go forward. All the stuff that they get. And
Sure.
That's really important. The second set of benefits has really become bigger and bigger the more we've understood it. And that is, there's a lot of studies by the Exit Planning Institute and other folks that have shown that 75% of people who sell their companies are not happy that they did so.
Yeah, interesting.
And it's either the way the buyer's running it's not good, or a lot of times it's just the fact that, especially with baby boomers, their lives are so intertwined with the company.
Sure.
Their social lives, their
Yep.
Life of relevance, they're
They're emotionally attached, right?
yeah. And when you disconnect them from the company, which normally happens in a third-party sale, no matter what the buyer says,
Right.
they get disconnected, and that's very hard on them.
Yeah.
Maybe the first 3 months they play a lot of golf, and that feels pretty good. And
You can only play so much golf, right?
yeah. Then you get 6 months out, and well, it's still all right. And then by month 9 they get pretty bored, and then they're bugging the heck out of their wife, who they were never home with,
Right.
and now they're home with 8 hours a day or 20 hours a day. And so the ESOP is great because they control the exit. They can keep working as long as they want. They can taper back. They can travel.
Okay.
And then if they do eventually feel good about leaving, they can do that, but they control the timing.
Yeah. Now, you talked a little bit, obviously, about the financial part, the tax savings, and that can be significant, correct? If I do a 100% sale to an ESOP, what does that mean, big picture terms, in terms of tax savings?
There's a couple different ways it could go, but the main way that people do it is they'll sell 100%, and then they'll convert to an S corporation if they're not already an S corporation. And as an S corporation, it's a flow-through entity, as all you accountants out there know. And if the owner is the ESOP trust as a retirement plan doesn't pay federal tax, and in most states, almost all states, it doesn't pay state tax.
Which is obviously a great benefit for...
Yeah, so you can pay the owner back quicker, and that's a big benefit.
Because essentially, in a typical structure, correct, not all of the proceeds are paid to the owner at closing. There's a portion that's paid, and then the ESOP pays back over time, correct?
That's exactly right. And typically, whatever a bank would lend is what you get at closing, and then the rest is on a seller note. And different people do it different ways, but we typically will get about a 12% return on that seller note.
Yeah,
because you're behind the bank, and that's people like that.
Yeah.
And so when you add that 12% return, and you add and take the purchase price and the tax savings and all that, most of our clients, almost all of our clients in the middle market, end up with more money in their pocket at the end of the day than if they had sold to a competitor or private equity. Or now, there's exceptions, obviously, but most of them end up with more money, and they accomplish all the other stuff they're looking to get done.
They're happier because I think of that spectrum, and typically, historically, having dealt on the finance side with clients that are doing this or whatever the case might be, we would always say, well, if the least amount of return is if you sell it internally to a family member, that kind of thing. You're maximizing your return if you find some third-party, national player or something like that. Typically, the multiple's higher. But from what you're saying, if I'm a business owner, I can accomplish so much more through an ESOP. Yeah,
there's basically there's a third-party trustee who's a fiduciary that is your buyer. They're there to make sure it's fair to all the employees, and there's a valuation firm, and they're supposed to come up with a value very similar to the real world. And so, and they do. Now there's just from the way valuations are done, unloved in the real world companies like
Sure.
contractors and
Right.
niche plays,
Yep.
tend to do better in ESOPs. But if you're a high flying tech company
Yeah.
that's going to sell for a multiple of sales, or someone can come by you and take all your costs out and get rid of all your people.
Right.
In the real world, they're going to pay more.
Yeah.
But by and large, you get a similar purchase price, plus you get all that interest for financing it and all the tax savings. You end up better off.
Yeah. And I know from experience, you and I have worked through a number of mutual clients that have been just, extremely pleased at the end of the day with where they end up, not only financially, but again, all of those kind of more emotional and softer issues. They remain there. The employees are happy. They're happy. All those types of things. But let's talk about some of the difficulties with that. Some of the things that I've seen folks run into. They're not prepared for the level of, say, financial reporting, or the fact that, hey, I was an owner and I just kind of commingled my personal stuff in the business. Some of those issues have to be kind of worked through, correct?
Yeah, and we spend a fair amount of time with them up front, getting them to understand that this isn't your piggy bank anymore.
Right.
That you're going to sell the company and you're going to you get to pick, what you're going to earn going forward.
Right.
And the rest of it, that income, you're going to sell to the ESOP. And that, you're not going to do the ESOP and then go get a boat and a plane and a country club.
Right.
But you're going to do very well. You're going to get that whole purchase price. You're going to keep getting your salary and benefits. And you're going to get that additional, interest or other stuff.
Yes.
But no, it's not your piggy bank. And people, our clients seem to have gotten that.
Yeah.
Because we also bring in legal and accounting and, folks like you that also understand that. And so when we get that straight up front and then they have those people on an ongoing basis, we really haven't seen that be an issue. It's where that hasn't been made clear up front.
Right.
And people are just trying to throw it together because maybe they'll get some fees or something.
Right.
And they don't explain all that. That's when you get the problems.
Yeah. And oftentimes you find what we see is the level of financial reporting that then, say, the bank requires or the trustee requires. It uncovers opportunities within the business, things that maybe they weren't thinking about or weren't measuring very well. It really benefits everybody at the end of the day.
Yeah, we have the whole gamut. We have people that already are getting audits and they're ready to go and there's not much change at all. And then we have people who are doing compilations.
Right.
And, you and I just worked on a contractor who
Right.
needed to get their house in order. And I think it'll help them a lot because now they'll have better quarterly numbers so they actually know how they're doing.
Right.
Versus, wait until the end of the year and kind of, oh, that's what we did.
Yeah, yeah. The owner always intuitively kind of knew, but now you've got to share that information, be transparent with everybody, right?
Yeah, and if that owner who really had a good feel for the business by looking at, maybe each job or whatever, when he leaves, the next person may not have that intuitive feel because he didn't grow up in the business.
Yeah.
And you want to be able to leave something that someone else can run.
Exactly right. And I think you bring up a great point. One of the things we always struggle with in talking with clients about it is getting them to understand that the knowledge transfer is one of the most important aspects to this. And oftentimes that's something that gets overlooked. Has that been your experience too?
Yeah, you really have to commit to that. So we had I'll give you an example of someone who did it right, a trucking company in town.
Okay.
They did warehousing, brokerage, trucking, LTL, less than load.
Yeah.
And they had a president who was the chief sales guy.
Okay.
And they had a COO, CFO. And they said, okay, we're going to sell this. And in the next 3 or 5 years, we're going to train our replacement and be gone. The COO went out, found his replacement, trained him for a year, stuck around for another 2 years, working less.
Yeah.
Saw that it was working and left.
Sounds great.
The CEO that trained his replacement for a year and didn't work out so well.
Oh.
had to replace the
Replace
person.
the replacement.
Yeah, and train that person for a year, and it was looking great. So then he went 2 days a week, stayed on the board, and that's working out pretty well.
Good.
And he's still involved, but he's also traveling and playing golf and doing all that kind of stuff, and the company's doing great.
Good. So talk to me about, say, post-transaction. What does it look like in terms of responsibility? There's now obviously a fiduciary responsibility that is there that maybe wasn't there before. There's a board, correct, that's typically formed?
Yeah, if someone doesn't have a board already, you're going to have either usually a 3 or 5 person board. Often, 2 of the 3 or 3 of the 5 are the old sellers.
Mm-hmm.
And then you got to have at least one independent board member. Independent basically means they're not a vendor.
Gotcha.
And they're usually picked by the sellers to give some independence because they're not a vendor. And they're going to run the company. And the trustee is not always, but usually what's called a directed trustee, meaning they're directed by the board what to do. And they'll do it unless it's somehow going to violate ERISA. Now, they are obviously always independent with regard to the value of the company.
Sure.
That they have to be because they're the ones saying that the value is fair and determining that. But people sometimes worry that the trustee's going to be calling them every day.
Right, kind of in your face, right? What are you doing here?
Yeah. And what they find out when they look into it is they've got 100 or 200 or 500 clients, and ESOPs are incredibly popular. They're doing a lot of new ones, and they're taking care of the existing ones. They just want to get the financials and know everything's all right. Now, if the company is doing very badly for some reason,
sure,
they're going to ask, okay, well, what's the plan to fix that?
Right.
And if you got a plan, there's no problem.
Right.
Now, however, if you say, well, we're 5 years down the road, I have all my money and I'm hanging out in Florida, and they say, what's the plan? And you say, well, my plan is I'll have another margarita. Well, that's a problem. And, then you are going to hear from the trustee because they're going to say, we got to fix that.
Yeah. Or hope. I hope things get better. I tell my daughters that all the time. Hope is not a strategy.
Yeah. Yeah. No one, the bank but that's really, really rare. If you look at the statistics, leverage buyouts, which is what an ESOP is, the tax advantaged leverage buyout.
Right.
Leverage buyouts fail about 19% of the time.
Okay.
ESOPs fail about 1/2 of the time.
Interesting.
And it's not because it's an ESOP, it's because, companies fail.
Right. Right. So you and obviously your firm, I mean, you travel around the country and are well known, obviously, in the world of ESOPs. What do you see in terms of trends and things like that in the marketplace? I mean, is financing still pretty readily available? Lenders being aggressive that you see? Any particular industries or anything like that you're seeing?
Yeah, we see all industries. We tend to get a lot of contractors and a lot of professional service firms. Contractors because there's not really a logical buyer, and it's hard sometimes for the knowledge transfer.
Yeah.
And ESOPs really help with all that. And then professional service, because if you think about it, all you have is elevator assets. They
Right.
walk out the door at night. You want them to come back.
Right.
And so recruitment, retention, all that kind of stuff is better. So we do a ton of those, but we do manufacturing, distributing, distributors, et cetera. In terms of trends, the values have been growing, and they've sort of peaked right now.
Okay.
The tax law changed by the way ESOPs are done. It's obviously cash after taxes, and when they lowered the taxes, it raised values.
Right.
15, 20%. And
Sure.
so that helped. And then the stock market and the economy and everything else. We are starting to see people look at the projections because every time you do an ESOP, you'll project out 5 years what you're going to do. And everyone knows you don't know what you're going to do the next 5 years,
Right.
but give us directionally what you're going to do. And then they kind of look at that and then project that out forever. And they say, okay, all that cash flow is worth a number.
Yeah.
Well, they're starting to say, whereas before maybe we'd, agreed that the next 5 years would be very nice growth.
Yeah.
Maybe hey, the economy's been going a long time.
Pretty good, right?
Pretty good, and seeing a little bit of signs that maybe there's some stuff out there.
Yeah.
Maybe we'll temper that a little bit.
Okay.
We'll still buy into growth, but maybe we'll be a little bit
more conservative in terms of determining that future cash flow, basically.
Yeah, you still get a great value, and then the banks are doing something similar.
Okay.
Especially with contractors.
Yeah.
Less so with maybe some other folks.
Sure.
If you're an all-service business or you're insulated against the economy, they're not. But for the cyclical businesses, they're starting to factor in a little bit.
Yeah.
Maybe we'll, lend a quarter less of cash flow than we would have.
Sure. But for the bank and everybody involved, if you've got an initial piece that's financed, that's cash out to the owner, and then there's a seller note for the remaining piece, that also leaves some flexibility, right?
Oh, absolutely.
In terms of what you can do.
Yeah, people are constantly worried, hey, am I strapping the company? And what they find out is when you take out all taxes, you'd be shocked how much cash flow is there. So normally what we see is there's about twice as much cash flow as you need.
Sure.
When you do an ESOP,
right.
To pay the bank and the seller and all that stuff.
Yeah.
Because that's the way we structure them, to have some really nice cushion, and so we rarely have companies getting in kind of trouble.
And then they have the ability, obviously, maybe a couple of years in to come back and perhaps do another round of that. Or, in fact, I know we've got a client who has been literally an ESOP for 30 years, and it's long been paid off, but now they're going to recast that. Do you see those kinds of things happening?
Yeah, on new ESOPs, because the owner wants to get paid the money the road, and because the company's tax-free, the bank debt gets paid down incredibly quickly, and then we'll see banks, since they got paid down, refinance every year or two to get the seller more money.
Yeah.
And the seller normally will have the whole purchase price in 4 or 5 years.
Wow, that's great.
And then they'll have that extra interest in another year or two.
Yeah.
So they get it really quickly. And that's why we almost never see management buyouts work, because if you try to do it with after-tax dollars, it doesn't really work out very well. It takes 15 years, or it takes a long time. Whereas with the ESOP, because you're tax-free, you can pay it back really quickly.
Yeah. What about the increased value for the employees over time? You hope, obviously, the business is successful when their individual share value increases, and then at some point they have to, maybe they retire at some point and they want those shares repurchased. Do we typically run into problems with that, or is that kind of built into the modeling?
Yeah, so ESOPs, the key are to do them right up front and to plan for all that stuff. If you do that, we don't have any problems. But people who don't plan for that, it is a problem.
Yeah.
But there's some built-in safeguards.
Okay.
So, for example, first of all, there's good value appreciation because even if the company doesn't grow, if you think about it, let's say you sell your company for $10 million and you got $10 million of debt, to the bank and to the seller. Well, every dollar of debt you pay down is a dollar of equity. Well, and because now you're not paying taxes anymore, you're paying that debt down very quickly.
Right.
So even if the value of the company doesn't grow, the equity value grows very quickly.
Sure.
So there's a lot for the employees. And because you're not paying tax, there's also a lot more cash to buy back shares in the future.
Sure.
But the built-in safeguards are a couple. One, when employees get stock, they get stock every year. That stock vests over 6 years.
Okay.
So if you do a new deal, people aren't going to invest for 6 years. They invest partially, it's 0% and then 20%, then 40, 60, 80, 100. But, they're not fully vested until 6 years. And then if they leave, typically the company can wait 5 years and pay out over 5 years because it's retirement.
Right.
And then the employee can take that money and put it in an IRA or a 401k. But there's some time built in there for the cash flow.
So they've got some runway in essence.
They got some runway,
Yeah, that's great.
And there's some other safeguards we don't need to go into that also help out. But yeah.
Well, it sounds like it's something that any owner who's looking to perhaps think about that transition or succession or exit over time or a liquidity event of some kind. It's a great potential avenue for them to pursue.
Yeah. Just about all companies. Where it doesn't work well is again, you don't have management. The second thing is you get less cash at close.
Yeah.
If people are looking to get most of their cash at close, that's not an ESOP.
Right.
I mean, there's ways we can do that with mezzanine and equity, but most people don't want to do that.
Right.
So those are kind of the drawbacks. What you gain, though, is you get rid of stuff that you get in third-party sales like escrows and earnouts, all that stuff where, hey, we're going to give you money at close, but you got to earn
Not really.
Yeah, but the rest of it you got to earn, and maybe we're not going to give it to you, and we're going to fight you for it.
Exactly.
You don't have any of that stuff.
Yeah.
And you get all that interest and all that other stuff we talked about.
Yeah, that's great.
So if people like that idea, and they're the right age, and then they should think about it.
Something for business owners definitely to consider. So that's awesome. Well, thank you, Ted. If you want more tips and insight, or to hear previous episodes of Unsuitable, visit www.raycpa.com/podcast. Thanks for listening. You can subscribe to Unsuitable on iTunes or wherever you like to get your podcasts, including YouTube. I'm Doug Hauser. Join us next week for another Unsuitable interview from an industry professional.